There's a shakeout happening in semiconductors right now. On the surface, everything looks bullish. AI is booming, Nvidia is dominating, stocks are running. But underneath it, the winners and losers are quietly being separated and the market is mispricing it. Everyone's chasing the obvious names, but the money that comes next will be made by those who understand what's really changing. Not on the front page, but deep in the margins, deep in the infrastructure. Because the businesses that survive this next wave won't be the loudest. They'll be the ones with operational leverage, rising cash flows, and a strategic position that's getting stronger every quarter. And here's the uncomfortable part. Some of these companies just posted record numbers, massive revenue growth, fat margins, all-time highs, but not all of them are built to keep it. That's the problem, and most investors don't see it coming. This video isn't about Nvidia. Nvidia is the king of AI. I hold it, I'm bullish long term. This video is about what happens underneath Nvidia, the lesser known giants with leverage to the AI explosion, not in hype, but in real contracts, real supply chains, and real chip architectural shifts. You've got Applied Materials, Micron, Broadcom, all three are riding the same AI wave, but only one of them is doing it with margin power, consistency, and execution. I'm not here to call tops. I'm not here to throw out price targets. I'm here to break down exactly what's going on by the numbers. And by the time this video is over, you'll know which of these three stocks is built to lead, which one is skating on momentum, and which one might leave investors holding the bag. Let's get into it. Applied Materials isn't flashy. It doesn't trend on social media. But if you're serious about who's powering the AI explosion from the ground up, this is where you start. While Nvidia steals the spotlight, AMAT is quietly building the machinery that makes all of it possible. We're talking about wafer fabrication equipment, the backbone of advanced chip production. And AMAT owns the broadest portfolio in the space. Etch, deposition, process control, they're in it all. But here's what matters right now. AMAT just delivered record earnings per share. Free cash flow margins over 20%, cash return on invested capital above 23%. These aren't good numbers, they're elite. That's execution, that's scale, that's leverage to AI without the volatility. More important, AMAT is sitting at the center of two of the biggest transitions in semiconductor history. One gate all-around transistor architecture. Two, backside power delivery. Both are critical for the next generation of high-performance AI chips. And guess who's winning the most design wins across both? And there's more. Applied Materials DRAM customers are ramping hard. Revenue from this segment is expected to grow over 40% this year, driven by the push into high bandwidth memory. That's the same HBM that's become essential for AI training workloads. Look at the margins, look at the cash, look at where this company is positioned. This isn't about catching a lucky quarter. This is about a company whose core business is aligned with the direction of the entire industry. Most investors overlook Applied Materials because it doesn't scream AI. But if you follow the money, if you follow the foundries, it's clear. AMAT is building the tools for the companies that are building the future. This is a real business with real cash solving real problems, and it's doing it without the hype. Next up is Micron, ticker MU, and they just recently crushed earnings. Revenue jumped 46%. They broke records in data center sales, and they're ramping one of the most important technologies in AI, HBM. That stands for high bandwidth memory. It's the ultra-fast memory that sits right next to the AI chips inside data centers. If you're training large AI models, you need this kind of speed. And Micron is now the #2 player in data center memory. That's a huge move. But here's the issue. Micron's core products, memory chips, are still commodities. There's no moat, no pricing power. When supply ramps faster than demand, prices crash. That's how Micron went from record highs in 2022 to a brutal down cycle in 2023. Yes, they're improving tech. Their latest chips use less power, deliver faster speeds, and they're winning business in servers, phones, and automotive. But the business model hasn't changed. It's still built on chasing demand cycles, and that comes with risk. Their cash return on invested capital is just 3%. Free cash flow margins sit at just 5.6%. These are thin numbers for a company this size. And while the growth looks exciting, it's being built on a foundation that moves with pricing, not dominance. They're making huge investments in U.S. manufacturing, backed by $200 billion in planned spending. That's a long-term bet, and it shows ambition. But it also means they're tying up capital in a business that's structurally volatile. So here's the truth. Micron is a strong operator when the wind is at its back, but this is not a stable compounding machine. This is a trading stock. You ride the uptrend and you get out before the cycle turns, because when memory pricing drops, and it always does, Micron drops with it. Next up, we have Broadcom, ticker AVGO, and they don't make headlines the way NVIDIA does. But behind the scenes, it's one of the biggest winners in the AI arms race. While other companies are pitching AI potential, Broadcom is already cashing the checks. Last quarter alone, they pulled in $4.1 billion from AI chips, up 77% year over year, and that number's still climbing. We're talking about real revenue from real customers, hyperscalers, data centers, big names investing in custom silicon to move faster and reduce dependency on NVIDIA. And that's just one side of the business. The other half is software. After acquiring VMware, Broadcom is now one of the few companies selling critical infrastructure tools to the world's largest enterprises, governments, financial firms, and global cloud providers. These are sticky clients, high switching costs, deep contracts. Now here's where it gets serious. Broadcom turned 40% of their revenue into free cash flow. Their net profit margin sits above 22%, and they've done it while scaling AI chip production and expanding software growth at the same time. That's rare. Most companies get margin compression when they grow fast. Broadcom gets more profitable. They're not chasing hype, they're executing. But there's one thing to watch. Expectations are sky high. They're now priced like a company that can't afford to stumble. That means you have to ask a hard question. How much perfection is already baked in? Broadcom is a machine. The balance sheet is strong. The business model is sharp. The execution is elite. If you're already in, you've been rewarded. The challenge now is timing your next move without getting greedy. Because when a company starts doing everything right, that's when the market starts assuming it'll never go wrong. So let's make this simple. 3 companies all riding the AI wave, but only one of them is winning where it counts, in the cash. Broadcom, they're a monster. For every dollar they bring in, they turn almost 40 cents into free cash flow. That's not just good, that's elite. Most businesses would kill for half of that. Applied Materials, no slouch either. It's clocking in with over 20% free cash flow margins, and it's doing it by building the machines that build the chips. Quiet operator, real strength. And Micron, just 5%. That's not leverage, that's a flashing yellow light. Now let's talk returns, not stock price. I'm talking real return, what the business earns on its capital. This is where you find out who's running a business and who's just keeping the lights on. Applied Materials, 23.5% cash return on invested capital. That's elite territory. That means the business is generating serious money from every dollar it reinvests. Broadcom, 16.2%. Still strong, still disciplined. Micron, 3%, which basically means lots of spend, not a lot of return. It's growing revenue, but the engine underneath is struggling to turn that growth into durable profit. Now, if that sounds like a finance class, let me break it down like this. Broadcom is the A student who finishes early and still crushes the test. Applied Materials is the silent grinder. Shows up, gets it done, delivers real results. And Micron is the guy who looks great when the questions are easy, but bombs when the cycle changes. And the cycle always changes. So if you're asking which one is winning the war, the scoreboard is right here. Cash, margins disciplined, Applied Materials and Broadcom are running businesses. Micron's still chasing the boom. Now let's talk real strategy. If you're building a portfolio for the next 5 years, not the next 5 days, you need to be clear on what each of these companies really is. Applied Materials. This company has a moat. It's embedded in the manufacturing process of every major chip maker on the planet. From gate-all-around to backside power, they control the tools behind the most advanced chips being built today. It's not easy to replicate. It's not easy to replace. That's a real advantage. Strong margins, strong cash, strong execution. Applied Materials doesn't make headlines, it makes money. And Micron, no moat. This is the hard truth. Micron's memory chips are commodity products. Prices go up, Micron makes money. Prices go down, Micron gets crushed. It's a great operator in a tough market. Yes, they're innovating. Yes, HBM is growing, but there's nothing stopping another player from cutting prices and stealing share. That's not a long-term fortress. That's a cycle you have to time. And Broadcom, wide moat, they're locked in with major hyperscalers for custom AI silicon, and their enterprise software is sticky, high margin, and hard to rip out. That combination gives them leverage across multiple industries. The risk isn't competition, it's that they're so good the stock already reflects it. It's priced for perfection. You don't want to chase that. So here's the final cut. Applied Materials has a moat and is still underestimated. It's the silent leader. That's the name with staying power. Micron is the opposite. No moat, no pricing power, all momentum. And Broadcom, wide moat, incredible business, but you're paying up to be there. If you want durability, defensibility, and cash stacking year after year, you go with a company that owns the foundation. That's Applied Materials. Now let's rank these three companies not by stock price, not by hype, but by who's actually building a real defensible business in the AI era. Number 3 is Micron. This is the easiest cut. Yes, the growth looks exciting. Yes, they're ramping high bandwidth memory, but it doesn't matter. There's no moat, there's no pricing power. Memory chips are commodities. When prices rise, Micron looks like a star, but when the cycle flips, and it always does, the bottom falls out. It's not a business you hold, it's a trade you time. For me, it's a pass. Number 2 is Broadcom. This is a machine. Big revenue, big cash flow, big moat. They've got custom silicon deals with hyperscalers and enterprise software that's hard to rip out. This is one of the strongest operators in tech, but that strength comes at a price, and the market knows it. The stock is priced for perfection. One stumble and the drop could be sharp. That said, the business is elite. It's a solid number 2. And number 1, Applied Materials. This is the quiet winner. They've built a moat around the most critical process in the semiconductor stack, the equipment that makes everything else possible. Their cash return is strong, their margins are solid, and they're positioned right at the center of next-gen chip architecture. Gate all around, backside power, stacked DRAM. The world's biggest chip makers rely on Applied Materials. That's leverage, that's scale, that's power. So here's your takeaway. Micron is out, Broadcom is strong, but fully valued, and Applied Materials is the one that's still being underestimated. No flash, just fundamentals. That's the stock with staying power. And here are my final thoughts. If you're not making money, it's your fault. And at this point, you've got 2 options. Option 1, you take action, you stop chasing headlines, you stop guessing, and you start following a system that works. The same system that has my portfolio up over $1.7 million this year, a 49% gain and counting. But here's the key. Most of that didn't come from trading. It came from holding great companies over time. Real conviction, real positions, real growth. And when it's time to boost returns, we use options the right way. Not to gamble, not to guess, but to stack profits on top of already winning positions. If you're a long-term investor who wants to get smarter, faster, and more consistent, my Patreon is exactly where you need to be. Or option 2, you do nothing. You keep overthinking, keep watching videos without execution, and 6 months from now you'll wish you moved. But the window will be gone. And if you missed my last video, we nailed a clean breakout on Palantir, locked in 43% profits in hours using a high probability setup. We already rolled those gains into the next play. That's how you stack, that's how you scale. And inside my Patreon, you get real-time trade alerts, actual setups with entries, exits, and reasons, daily market breakdowns, the plays that matter, simplified. My full option strategy designed to be safer, smarter, and built for long-term investors. This isn't gambling, this isn't hype. This is how you grow accounts with confidence, even in tough markets. You've seen the winners, you've seen the system, you've seen the results. Now the only question is, are you ready to use it?